regulator, the big one within the banking circle, it's the RBI, which has now issued this circular. It details changes in the risk weights for microfinance loans. It's effective immediately. So these microfinance loans for consumer credit is now going to attract a risk weight of 100%, which has been reduced. Earlier, it was 125%. So obviously, this is going to have an impact on the industry, on lending, as it were. And Anjali Palod is here, my colleague at ET Now, to tell us exactly what's really changing. So Anjali, the RBI has changed its stance in terms of risk weights for microfinance loans and banks' exposure to NBFCs. So how do these changes really compare to the previous framework? If you can lay out the context and explain to us what exactly is changing.
That's right. In some relief to microfinance lenders, the Reserve Bank of India has come out with two circulars revising the risk weights for microfinance loans as well as banks' exposure to NBFCs. Now, the first circular, which talks about the microfinance loans, especially in the consumer credit category, they will now attract 100% risk weight as opposed to 125% that was levied on these loans in a November 2023 circular. Additionally, the new circular says that banks can now classify loans under the regulatory retail portfolio, which will attract a 75% risk weight if all the conditions for this particular category are met. And all microfinance loans that are extended by regional rural banks as well as local area banks will now attract a risk weight of 100%. So this is a good news for microfinance lenders, as they were currently attaching a risk weight of 125% on microfinance loans in the consumer credit category, and this has been brought down to 100% now. Now, these changes will be effective from the date of this circular, and they will be applicable on the outstanding loans as well as any fresh loans that are issued. The second circular talks about the bank's exposure to NBFCs, and this says, and in this circular, RBI has restored the risk weight on banks' exposure to NBFCs to now external rating levels. These revised risk weights for banks will now be effective from 1st of April 2025.
Anjali, thanks very much for filling us in with those bits of information that we are gathering about the impact of this. But let's decode the impact on the lending business. And for that, Mr. G.T. Maman is joining us, Executive Director and CEO at Sadhan. Mr. Maman, great to have you with us on the phone line. Do tell us, the RBI now changing risk weights for microfinance loans and the kind of exposure that banks have to NBFCs. How do these changes compare to the previous framework?
Thank you for having me in this call. If you see that November 23 circular, that has increased the risk weightage for the banks for the non-secured assets, and that has impacted the microfinance sector also to some extent, because some of the banks were taking microfinance sector also under the same category, especially the consumption loans which were given under the microfinance was also created part of that circular only. And this has impacted the microfinance institution in a way because their fund flow has reduced considerably. Because you know that microfinance institution depend on the banks or higher lending institution for the purpose of borrowing money. And if the money doesn't come on time and sufficiently, their expansion, their growth also will be affected. So that was a problem which was been facing, and we have been taking up with the government, with the RBI as well as the government, and I'm really thankful to the RBI that now they have relaxed that. In fact, let me also add here that recently we had a meeting with the new governor of the Reserve Bank of India on 13th of February, where we raised this issue very firmly, and I think probably the governor has been very kind.
So the governor was very receptive to the idea, so that's why we are seeing that shift from 125% of risk weight. It's now moved down to 100%. So in terms of the impact that we are likely to see on capital requirements and overall lending capacity for organizations like yours, tell us materially how much this will change.
The point is that it's basically the flow of money from the banks. So earlier, or banks or the higher lending institution for maybe DFI or even NBFC for that matter. The point is that when the money was being lent to this microfinance institutions, they had to keep a higher risk weightage for the loans which were given for the unsecured purposes. Now that won't be there, so to that extent their capital will be saved, and MFI would be in a better position to get more money, and that will help in expanding the microfinance.
Right. But Mr. Maman, this 100% risk weight is applicable to regional rural banks and local area banks as well. So these smaller banks, with this kind of regulatory shift, what kind of impact do you see on them?
The banks, of course, their direct lending is what you are talking about.
Exactly.
Yeah, definitely, there would be more care has to be taken as far as the lending to such entities are concerned.
Right.
So, to that extent, probably some decline probably you may find, but I'm from the microfinance sector. I feel happy about it because of the money flow from the banks to microfinance would be. I think it will be in a better position.
So in terms of the effect on the cost of borrowing, if you can give us some indication of how much this is going to change.
See, ultimately, the microfinance institutions raise the money only through borrowings.
Right.
And if they have to raise the money at a kind of a affordable rate, the fund should be available in that. Otherwise, the whole, the entire, the calculation will go every, and it can result in a kind of a higher interest rate. And that is something which has been talked about by none other than even the previous governor.
Yes.
Of the higher interest rate. So one of the reasons for the higher interest rate is mainly because of the cost of funds, because the interest rates are calculated based with four components in with the four components, that is, one is cost of funds, operational cost, risk cost, as well as margin. And if the cost of funds are higher, ultimately it is going to result in the higher pricing as far as the microfinance loans are concerned.
Very true. But
to some
yes, go ahead.
And so this change, I'm sure, will help in reducing the interest rate by at least some few basis points.
A few basis points, you say. But tell me, the higher rated NBFCs, will they get easier access to funds, and the lower rated ones, do you think they will face higher capital costs? How is this going to impact their lending rates?
No, that would be always the higher rated NBFCs will be definitely in a better position to access more funds, and they'll be in a position to raise funds from various sources. Whereas lower rated entities generally have a problem of raising funds. But I'm saying that this kind of support from the banking system will help even the middle level or even the lower level institutions to borrow quite easily. In fact, let me also tell you, prior to that November 23rd circular, many of the banks were quite liberal in lending to even to the BBB rated NBFCs and even BB rated, I have seen. Some of the major banks like State Bank used to lend to liberally to these institutions.
Yes, even if you consider what happened November 23, but when you consider these risk weight adjustments now, what is the broader message you think the RBI is sending out? Is it about ensuring financial stability? Is it about curbing excess risk? Or is it about balancing credit growth?
It's all the three, I would say.
Fair enough. But what should MFIs and NBFCs do, sir? Now, to navigate these regulatory changes, maintaining business growth, how exactly do you think that approach is going to change as well?
See, you know that at the moment microfinance is going through a little tough of a time. Overall, the portfolio has come down significantly. In fact, if you see the last 9 months performance, almost 50,000 crore reduction in the portfolio, you can see. So if that happens and it continues to happen, the sector will be in a real trouble. So this kind of a help will benefit the sector to grow, and they will be able to expand further.
But what's your sense, Mr. Maman, before I let you go, do you think there could be further regulatory tweaks in the coming months, or does this signal that the RBI's stance on risk management for the foreseeable future at least is done?
Let's wait and watch. I'm not able to predict at the moment.
Right.
Let's wait and watch.
Fair enough. Mr. Maman, such a pleasure talking to you.
Thank you. Pleasure.
Such a pleasure. So as the RBI fine-tunes its risk management framework, the message is clear. They're trying to strike a balance between financial stability and credit flow. That is key. While MFIs, they may get some relief with lower risk weights, NBFCs, they will need to adjust to the return of rating-based capital requirements. And the big question now is whether these measures, they will lead to tighter lending conditions, or if lenders can find ways to optimize their portfolios. But one thing is certain, both MFIs and NBFCs, they'll have to stay nimble It's an evolving regulatory landscape, and we'll be tracking how this plays out. But meanwhile,